Welcome to Session 5 of Market Risk Management. In the previous sessions, we understood what market risk is, how it is measured using tools like PV01, VAR, and stress testing, and how limits are set. In this session, we move to the most practical part, how risk is monitored and controlled every single day inside a bank, and why liquidity risk can turn measured risk into real losses. Let us step inside the daily risk control process. In this session, we focus on what really happens after trading ends for the day. You will understand the daily risk control workflow followed in banks from trade execution to end-of-day reporting. We will see how limits are not just numbers on paper, but how they are actually enforced through systems and risk teams. You will also learn the critical role of the risk management team after market closes, when all positions are reviewed and validated. And finally, we will understand the reality of liquidity risk in trading books and how practical control failures can lead to large losses. This session is about real-life risk control, not theory. This slide shows the real backbone of market risk control inside a bank. This sequence happens every single trading day without exception. First, during the day, traders execute deals, bonds, FX, swaps, futures, options. Positions keep changing continuously. After market closes, the system performs end-of-day mark-to-market. Every open position is revalued using current market prices. This gives the true profit or loss for the day. Once MTM is completed, the risk system automatically generates the key risk numbers, PV01, duration, delta, and VAR for the entire portfolio and for each desk. Next comes the limit utilization check. The system compares these numbers with the limits set for the desk, PV01 limits, VAR limits, position limits, and stop-loss limits. If any limit is crossed, a breach report is generated automatically. Now the role of the risk team begins. They do not rely blindly on system numbers. They validate the MTM, verify positions, and ensure no trade is wrongly booked to hide exposure. Finally, a daily risk report is prepared and sent to the Treasury Head and Chief Risk Officer. Only after this process is complete is the trading day considered officially closed from a risk perspective. This discipline, repeated every day, is what prevents small exposures from becoming large losses. Mark-to-market, or MTM, is one of the most powerful control mechanisms in market risk management. At the end of every trading day, all open positions are revalued using current market prices, whether the position is in profit or loss. This means even unrealized losses immediately become visible. The bank does not wait until the bond matures or the contract ends to recognize the loss. Because of MTM discipline, problems are seen early, when they are still small and manageable. Without MTM, traders could carry losing positions for a long time without anyone noticing. MTM ensures complete transparency of the true financial position of the trading book every single day. Once MTM and risk numbers are generated, the next automatic step is the limit check. The system compares